Are we looking at the single greatest architectural build-out in corporate history, or are we just staring down a multi-billion-dollar sinkhole that's been cleverly disguised as progress? Welcome back to this Iron Financial Explainer. Our mission here is simple. We want to help you forge a much stronger portfolio and completely cut through the market weakness. I'm your lead analyst, and today we are breaking down Alphabet's massive, highly anticipated Q1 2026 earnings report. Listen, traders have been waiting literally months for these exact numbers to drop. Why? Because Alphabet's massive infrastructure spending essentially sets the baseline reality for the entire tech sector.
And I'm the Market Skeptic. I'm here to ask the hard, uncomfortable questions that I know you're all thinking at home. Alphabet is throwing an absolute, unbelievable mountain of cash at artificial intelligence right now. We need to know, is this foundation actually ironclad, or are these top-line numbers just a beautiful facade hiding some massive structural vulnerabilities?
So let's just set the stage with the most staggering number floating around Wall Street today. $179.3 billion. That is the projected capital expenditure for Alphabet by fiscal year 2026. Now, for some much-needed context, they spent just over $32 billion back in 2023. That is an exponential leap. They are pouring a historic, frankly terrifying amount of concrete to build out this AI infrastructure. My main question is, are they building an impenetrable fortress, or is this literally a $179 billion trap built on pure, unadulterated AI hype? Look, it's incredibly easy to get vertigo when you're looking at those CapEx projections, I get it. But you have to understand the construction business of big tech. You have to spend massive, heavy capital to forge the future. You can't build a skyscraper on a wooden foundation. And today, I am going to drop the hammer with the real, concrete numbers from Q1 that prove this foundation is already bearing immense weight.
Okay, let's dive straight into this. We are officially initiating the drill down. It's time to bring out the heavy machinery and closely inspect the top-line structural integrity of Alphabet's first quarter. You honestly can't evaluate the cost of the raw materials until you look at what the property is yielding today.
Fair enough. Let's look at the actual earnings, because Wall Street is watching every single brick being laid right now. They're analyzing every single dollar of that capital expenditure to see if it yields actual cash flow today or if it's just, empty promises for tomorrow. Now, the market was expecting around $107.1 billion in total revenue. Did this massive spending spree actually translate into tangible growth, or are we literally just watching them burn cash in real time?
Oh, they absolutely smashed it. Alphabet reported $109.9 billion in total Q1 revenue. That is a massive 22% year-over-year growth, completely blowing right past Wall Street's $107.1 billion consensus. To put that into perspective for everyone watching, this is their 11th consecutive quarter of double-digit growth. Pulling off that kind of sustained, rapid expansion for a mega-cap tech company of this sheer titanic size is nearly unprecedented. It practically defies the law of large numbers. Usually, when companies get this heavy, they start to buckle under their own weight, but Alphabet, they are somehow accelerating. Okay. A 22% top-line expansion is undeniably heavy. I'll give you that. But revenue is just the top floor of the skyscraper, right? If they're aggressively slashing their prices or essentially just buying that growth to look good, the bottom line is going to show some serious cracks. I want to see the real profit. Then let's break down the financial scaffolding frame by frame right here. Just look at the operating income. It jumped 30% year over year, coming in at an absolutely incredible $39.69 billion. And their net income, it skyrocketed 81% to a staggering $62.5 billion. Whoa, hold your horses there. Let's be totally transparent with the viewers here. That 81% net income jump, that includes a massive $37.7 billion net gain, primarily from unrealized gains on non-marketable equity securities. That is a paper gain. Those are investments they made in other startups that went up in value on paper, not actual cash generated from selling search ads or enterprise cloud storage. If those specific startups tank next month, that paper gain completely vanishes into thin air. That is a completely fair point to call out, and you're absolutely right to look closely at that. But look back at the operating income, up 30%. That is their core business profitability, completely stripping out all of those investment gains. The actual operational engine of this company is absolutely roaring.
But here is the stress test I really care about. Alphabet spent $35.67 billion in Q1 capital expenditures alone. That is an insane amount of money going into servers, silicon chips, and massive data centers. We've seen tech giants completely crush their near-term profitability for long-term bets before. Just look at the ridiculous cash Meta burns trying to build a metaverse, or Amazon sacrificing years and years of earnings just to build AWS in the early days. The depreciation costs on that kind of AI infrastructure must be astronomical. Are they bleeding cash at the margins just to keep this AI dream alive? That was the exact fear hanging over the stock heading into this quarter. But the data tells a completely different story of structural strength.
Look directly at the proof of margin leverage right here. Notice how the operating margins actually push higher. Despite that $35.67 billion in CapEx heavy lifting, their margins actually expanded. They went from 34% in Q1 2025 up to 36.1% in Q1 2026.
Wait, let me get this straight. So their profit margins expanded by over 2 full percentage points while they were executing one of the absolute largest corporate capital expenditure programs in modern history?
Exactly. They are absorbing all of those massive depreciation costs without destroying their profitability. The blueprint is clearly working.
Okay, well, if the margins are actually holding up under that much pressure, there has to be a specific structural beam carrying all that weight. Core Search is incredibly mature. It definitely can't carry a 30% operating income jump all on its own.
You're right, it isn't. The real load-bearing beam of Alphabet's current growth phase, the critical asset validating all of this infrastructure spend, is Google Cloud.
Brace yourself for this number. Q1 cloud revenue hit $20.0 billion flat. That is a ridiculous 63% acceleration from last year's $12.26 billion. It completely shattered analyst estimates by a full $1.6 billion. Market Skeptic, 63% year-over-year growth on a baseline of over $12 billion. That implies an absolute undeniable surge in enterprise adoption. Precisely. And remember, this is incredibly sticky revenue. Once a massive multinational corporation migrates its complex databases and computing power over to Google Cloud, they rarely, if ever, leave. The switching costs are just way too high. This enterprise adoption provides a rock-solid bedrock of recurring cash flow that Wall Street absolutely loves, and it provides direct, undeniable evidence that Alphabet's aggressive AI build-out is generating tangible, real-world returns.
All right, let's weigh these forces head-to-head. On one side, you have this fantastic 63% enterprise revenue growth in the cloud segment. But on the exact opposite side, we have to go back to that looming $179.3 billion CapEx projection by 2026. Can this cloud growth realistically sustain itself long enough to actually pay off that massive, multi-year capital mortgage hanging over their balance sheet? And that right there is the absolute critical question for any investor even thinking about holding this stock. If the growth is just a one-time pop, the whole foundation crumbles. But management actually gave us a direct look at the blueprint for their future revenue.
Lead Analyst, CEO Sundar Pichai confirmed the structural integrity is real. He stated on the call, Google Cloud revenues grew 63%, with backlog nearly doubling quarter on quarter to over $460 billion. Market Skeptic? Wait, a $460 billion backlog? So they literally have nearly $500 billion of enterprise commitments just sitting there, waiting to be recognized as revenue? Exactly. That is nearly $500 billion in formally signed contracts where the cash is basically guaranteed, but the services are still being actively rolled out. It's essentially locked-in future revenue, and according to the data, it is converting significantly faster than the market had modeled.
And they aren't just sitting still, they are aggressively reinforcing that cloud structure. They just closed the largest deal in the company's entire history, acquiring the cloud security platform Wiz for a whopping $32 billion. Plus, they've massively expanded their partnership with Anthropic, committing to provide 3.5 gigawatts of compute capacity starting in 2027.
Market Skeptic. Now, that $32 billion Wiz acquisition is a very hefty price tag. We absolutely need to keep our hard hats on until we see exactly how that integration impacts the balance sheet over the next few quarters. Mergers of that size are notoriously messy.
It is a massive undertaking for sure. But the Anthropic deal? That's fascinating, because it signals a major strategic shift. Their custom tensor processing units, the bespoke silicon chips they originally designed in-house just to train their own AI, are no longer just an internal cost saver. They are now actively monetizing them as a highly lucrative, high-margin external offering.
So let's shift gears slightly. We're moving to inspect the AI foundation directly, specifically looking at consumer and enterprise adoption.
Right, because if you build an incredible ironclad skyscraper, but absolutely no one rents the offices, you eventually go bankrupt anyway. Are people actually using Gemini at scale?
The answer is entirely in the usage metrics. Alphabet reported their first-party models, like Gemini, are currently processing more than 16 billion tokens per minute via direct API used by their customers. That is up 60% from just last quarter alone. Think of tokens as the fundamental digital words and data fragments that AI models process. That massive, mind-boggling volume means the infrastructure is actively bearing immense weight 24/7. And that sheer scale is exactly why the Google Cloud segment just delivered a record 27% operating margin.
Let's move over to the consumer side and see how this builds a solid, unshakable revenue floor. Total paid subscriptions across their services like Google One and YouTube Premium have now reached a staggering 350 million. Now that is interesting. 350 million paid subs is a massive recurring revenue mode. It really insulates them from the pure volatility of the advertising market. When ad budgets inevitably get slashed during a macroeconomic downturn, which usually hits pure-play advertising companies brutally hard, those monthly automatic credit card charges for YouTube Premium and extra cloud storage, they just keep the lights on and the servers humming. It provides incredible structural resilience.
And the momentum isn't just in the core products either. Look at the operational updates across the entire board. Waymo has now officially surpassed 500,000 fully autonomous rides every single week. Meanwhile, Gemini Enterprise monthly active users are up 40% quarter over quarter. Alphabet's full-stack approach, meaning they own the silicon, they own the models, and they own the consumer distribution, is literally lighting up the entire business.
Okay. I have heard more than enough of the bull case today. As the market skeptic, it's my job to bring out the magnifying glass and inspect this structure for rust. And there was one major area in this report that did not hold up perfectly to Wall Street's stress test. Let's talk about YouTube. YouTube has been an absolute massive engine for Alphabet for years, but are there finally real cracks in the armor? With the relentless, aggressive rise of short-form video competitors like TikTok and Instagram Reels fiercely competing for user attention, ad spending is getting wildly fragmented. Advertisers just have way more places to park their cash right now, and I really need to see if this specific, historical load-bearing pillar is showing signs of structural fatigue.
Here are the actual numbers. YouTube ad revenue came in at $9.98 billion. That is a distinct miss against the analyst estimate of $9.97 billion. And honestly, what's more concerning, it represents a near 10% sequential drop from the $11 billion they pulled in during Q4 of last year. Look, I won't sugarcoat the miss, you're right. But let's be totally realistic about the calendar here. You have to remember that Q4 is always seasonally higher due to the massive surge in holiday ad spending. Comparing Q1 directly to Q4 is a flawed metric for any retail-adjacent business. Still, I will concede that it does show YouTube revenue growth is definitely moderating from its absolute red-hot pandemic-era peak levels.
But this next data point clearly illustrates a real area of structural fatigue, the Google network advertising business. This is their third-party ad network, and it actually declined 4% year over year, dropping from $7.25 billion to $6.97 billion. See, that absolutely proves there is continued serious pressure in third-party advertising channels. As cookie deprecation accelerates and Apple's app tracking transparency framework aggressively restricts how users are tracked across the internet, that older third-party segment of their business is absolutely showing undeniable signs of decay. They just don't have the same visibility they used to.
Market Skeptic. And while we are talking about financial pressure, let's look at the actual cost of maintaining their massive digital real estate. Traffic acquisition costs, or TAC, increased by 11% to $15.2 billion. For those at home, that's essentially the rent they have to pay to Apple and other device makers just to be the default search engine on your phone. True, TAC is absolutely rising. It's the unavoidable cost of doing business in mobile. But crucially, that 11% increase in costs grew significantly slower than their 22% top-line revenue growth. That right there is the textbook definition of operational leverage. They're actually making considerably more money out of the traffic they're actively buying.
All right, it's time to bring it all together. Let's get to the verdict. Is this an unprecedented opportunity or a colossal trap?
We've drilled down deep into the foundation today. We've inspected the load-bearing beams, and we've highlighted the cracks. Now it is time for your structural summary. On the side of immense strength, you have massive 36.1% overall margins, a staggering $62.5 billion net income fortress, and a cloud division that is accelerating at an astonishing 63% with a $500 billion backlog just waiting to be tapped. But weighed heavily against that, you have some very real opposing forces. A ballooning $179 billion multi-year capex build-out that they cannot back out of, a $32 billion acquisition that still desperately needs to prove its ROI, and slight but very real cracks showing in the YouTube and third-party ad networks.
Here's my final ruling as your lead analyst. The numbers absolutely do not lie. They build. Alphabet has undeniably proved they can absorb historic, massive infrastructure costs while simultaneously expanding their profit margins. The 63% acceleration in cloud revenue fully validates their enterprise AI strategy.
This isn't just hype, it's an ironclad foundation generating massive, tangible cash flow right now. For me, it's a clear buying opportunity. And as the market skeptic, I say, you have to respect the foundation, but keep your hard hats tightly fastened. The core business is incredibly strong, yes, but integrating a $32 billion security firm while simultaneously managing a $179 billion capital expenditure mortgage leaves absolutely zero room for error. One bad quarter, one misstep in that Wiz integration, or one sign that enterprise cloud spending is cooling off even slightly, and this entire stock could face a massive downward repricing. The market has literally priced this foundation for absolute perfection.
And that is the ultimate multi-billion-dollar question you have to ask yourself as you build and manage your own portfolio. Will Alphabet's massive $179 billion AI blueprint successfully forge the undisputed future of enterprise tech, or will the sheer crushing weight of this continuous infrastructure spend eventually collapse its own margins? The Q1 data shows a phenomenal fortress, but remember, the build is far from over. Thank you for joining us for this Iron Financial Explainer. Stay sharp, keep your foundation strong, and we'll see you right back here for the next drill down.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.